The God Pod was the nickname given to the executive wing of ExxonMobil's headquarters in Irving, Texas. It was where the top management of the oil giant made strategic decisions that shaped the company's direction and culture for more than 25 years. The name reflected the power and prestige of the executives who occupied the God Pod, as well as their isolation from the rest of the organization. Some employees described the God Pod as a place where dissenting voices were not welcome and where data and analysis were valued over creativity and innovation. The God Pod was also a symbol of Exxon's confidence in its ability to predict and control the future of energy. The company relied on its own forecasts and models to guide its investments and operations, often ignoring or dismissing external trends and challenges such as climate change, renewable energy, and social responsibility. However, in recent years, Exxon's God Pod era came to an end as the company faced mounting pressures from shareholders, activists, regulators, and competitors. The company's financial performance declined sharply due to low oil prices, high debt, and poor returns on its projects. The company also lost its reputation as a leader in the energy industry and faced growing scrutiny over its environmental and social impacts. In 2020, Exxon announced that it would relocate its top management from the God Pod to a new campus near Houston, Texas. The move was part of a broader restructuring plan that aimed to cut costs, streamline operations, and improve collaboration across the company. The company also said that it would embrace new technologies and opportunities to transition to a lower carbon future. The end of the God Pod era marked a significant shift in Exxon's decision-making and culture. It also raised questions about how the company would adapt to the changing energy landscape and whether it could regain its lost glory. ExxonMobil is one of the world's largest oil and gas companies, with a history of more than a century of exploration and production. But in recent years, the company has faced growing challenges from the global shift to cleaner energy sources and the rising threat of climate change. In 2021, ExxonMobil suffered a stunning defeat when shareholders elected 3 board candidates nominated by a coalition of investors who pledged to steer the company toward low-carbon technologies and away from oil and gas. The activist campaign argued that ExxonMobil was stuck in the past, failing to position itself for a coming transition to clean energy and addicted to big spending on oil and gas projects that no longer made financial sense. But has ExxonMobil really changed its strategy since then? The company says it is investing in low-carbon technologies such as carbon capture and hydrogen, which could help reduce greenhouse gas emissions from its own operations and from other industries. It also says it is supporting policies that put a price on carbon and incentivize innovation. However, critics say that ExxonMobil's low-carbon investments are only a fraction of its overall spending, and that the company remains fundamentally wedded to a future of ever more demand for fossil fuels. A future that all serious climate models say would unleash huge environmental damage. Unlike its European rivals, such as BP and Shell, ExxonMobil has not set any targets to reduce its absolute emissions or to achieve net zero emissions by 2050. It has also largely steered away from renewable energy sources like solar and wind, which it views as a money loser that it has little expertise in. ExxonMobil's focus on oil and gas and its reluctance to invest in renewable energy have led to its decline in market value and reputation. The company was once the most valuable public company in the world, but it has lost more than half of its market capitalization since 2014. It was also kicked out of the Dow Jones Industrial Average in 2020, after being a member for nearly a century. ExxonMobil's reputation has also suffered from its long history of denying and casting doubt on man-made climate change, and from its involvement in lawsuits and investigations over its role in misleading the public and shareholders about the risks of global warming. ExxonMobil faces a dilemma: how to balance its short-term profits with its long-term survival. The company says it is committed to providing energy for the world while addressing the dual challenge of meeting growing demand and reducing emissions. But many investors, activists, and consumers are not convinced that ExxonMobil is doing enough to adapt to the changing energy landscape and to contribute to the global fight against climate change. ExxonMobil, once the world's most valuable company, has been struggling to cope with the changing energy landscape. The oil giant has faced mounting pressure from investors, regulators, and activists to address its role in climate change and to adapt to a lower carbon future. In 2021, a landmark proxy fight led by activist hedge fund Engine No. 1 resulted in 3 new board members who advocated for a more aggressive energy transition strategy. Since then, Exxon has announced several initiatives to reduce its emissions and invest in low-carbon technologies. But how much has Exxon really changed? And what are the challenges and opportunities ahead for the company? The man in charge of leading Exxon's transformation is Darren Woods, who became the CEO in 2017. Woods inherited a company that was heavily invested in oil and gas projects around the world, but also faced declining profits, rising debts, and growing competition from renewable energy sources. Woods initially focused on cutting costs, improving efficiency, and expanding Exxon's portfolio of high-return projects, such as deepwater oil in Guyana and liquefied natural gas in Mozambique. He also maintained Exxon's commitment to pay a generous dividend to shareholders, even as the company borrowed money to do so. However, Woods soon realized that cost-cutting and project execution were not enough to satisfy Exxon's stakeholders, who demanded more action on climate change and more innovation on clean energy. In response, Woods launched a new business unit called Low Carbon Solutions in 2021, which aims to commercialize technologies such as carbon capture and storage, CCS, hydrogen, biofuels, and carbon-neutral fuels. Woods said that Exxon has the expertise, scale, and partnerships to become a leader in these emerging markets, and that the company could generate attractive returns by leveraging its existing assets and infrastructure. Woods also set new targets for reducing Exxon's greenhouse gas emissions by 2025, including a 15 to 20% reduction in the carbon intensity of its upstream operations, a 40 to 50% reduction in methane emissions, and a 40 to 50% reduction in flaring. He said that these targets were consistent with the goals of the Paris Agreement, and that Exxon would continue to evaluate further reductions based on technology development and policy frameworks. Woods acknowledged that Exxon's low-carbon strategy was partly driven by the changing regulatory environment, especially in the U.S. under the Biden administration. He said that Exxon supported a price on carbon as the most efficient way to reduce emissions across the economy, and that he welcomed the incentives and opportunities created by the Inflation Reduction Act of 2022, which included generous subsidies for CCS, hydrogen, biofuels, and electric vehicles. He also said that Exxon was engaging with policymakers and stakeholders to advocate for market-based solutions that would ensure energy affordability and reliability. However, Woods also faced criticism and skepticism from some analysts and environmental groups, who argued that Exxon's low-carbon investments were too little, too late, and too dependent on government support. They pointed out that Exxon still planned to spend more than 90% of its capital budget on oil and gas projects over the next 5 years, and that the company still expected global oil demand to grow until at least 2040. They also questioned whether Exxon's CCS and hydrogen projects were viable without significant cost reductions and infrastructure development. Woods defended Exxon's approach as realistic and balanced, saying that oil and gas would remain essential for meeting global energy demand for decades to come, especially in developing countries. He said that Exxon was not ignoring or denying the energy transition, but rather pursuing it in a way that would create value for shareholders and society. He said that Exxon was not betting on any single technology or scenario, but rather exploring a range of options that would enable it to adapt to different market conditions and customer preferences. Woods concluded by saying that he was confident that Exxon could overcome the challenges and seize the opportunities of the energy transition. He said that he was proud of Exxon's achievements in safety, reliability, efficiency, and emissions reduction over the past year. He also said that he was excited about Exxon's potential to innovate and grow in low-carbon markets. He said that he believed that Exxon had a unique combination of strengths and capabilities that would enable it to succeed in both the traditional and emerging energy sectors.